Hey, welcome back. Tax refunds may come later this year, even if you file on time. There are some things you can still do, though, to trim your tax liability. Financial strategist Kyle Waters has some advice. So why might refunds come late, even if you file on time or before April 15th?
Right. So the PATH Act was enacted in December a couple years back, and essentially for those people looking to do their refunds and get those refunds pretty early, they're going to be delayed until February 15th at the earliest. By the time you account for IRS holidays and weekends, they're really not going to be getting that money until the end of February.
Who does that affect?
You know, it really just affects those that are used to filing really early.
Okay.
So those that are looking at what's called the earned income credit and the additional child tax credit. So not everybody, but for the people that are looking for money early after Christmas shopping,
right,
they're in for a bit of a wait.
And those in a lot of cases are going to be lower and moderate income people who do depend on that refund.
For those that need it, it's probably not coming soon.
Right. Let's talk about what everyone can do to kind of limit or reduce your tax liability. There are a couple of things that have always been the case. If you have a little bit of extra money, you can wait after the first of the year and throw it into a retirement plan.
That's right. So you want to look at things like, you know, now's the time up until you file in April. You can do a regular IRA or you can do a Roth IRA. Both of those are going to give you tax savings moving forward as you're saving. So you really want to look at which one do I do, and that depends on your income and it depends on your tax plan moving forward. Okay,
and let's also talk about starting to gather some information. And Texas is a unique state since we don't have a state income tax. We have something else, but we need to do a little bit of work on it.
That's right. So you get to choose your state income tax, your state sales tax. We don't have a state income tax, so we pick our state sales tax. That can really add up over time. So if you're keeping track of your receipts, or if you didn't last year, start doing it this year. You can add all that up and take a pretty big deduction. The IRS also has what's called specified items. So if you bought a boat, if you bought a car, make sure you add that in there. That can really be a big saving over time.
So you take the big ticket items and you actually get to treat those differently. There's a standard formula for you make this much money, you get to deduct that. If you don't, you didn't save every receipt from every trip to the grocery store.
That's right.
Right. But if you have a big ticket item, make sure that you know how much the sales tax was that you paid on that. You have to be able to prove it.
That's right. That's right.
Okay. Also, any charitable deductions, you want to gather that information. What do you need as far as a charitable deduction? A lot of people will drive through, drop off a bag of clothes at Goodwill or the Salvation Army, and they get handed a blank receipt.
Right. Well, so it's always a good practice to keep your receipts. When it comes to charity, the biggest thing to remember is if it's over $250, you need basically credit, or you need notification from the charity of that contribution. But another thing is it's not just cash, like you'd mentioned. Also think of clothing and all those other items. You can go on irs.gov and it'll give you values for all those deals. Make sure you add them all up. It can make a big difference.
And you say the biggest mistake people make is procrastinating as far as getting your information together, getting things prepared.
Well, taxes are not that fun and they're not that simple. So basically, you know, your tax organizer sits on your coffee table all the way up until March. The real danger of procrastination is when you want to go meet with your tax advisor, your tax planner, so does everybody else. If it's the end of March, beginning of April, you want to get a tax plan together, and so do 100 other people trying to get a meeting. So
the fact of the matter is, and you do a terrific job for your clients, most people don't need you. Most people don't need you.
That's very true.
Right.
That's very true. But even if you're doing it yourself, don't wait till the last minute. It doesn't do you any good. And then you could be missing potential really important items. You might as well get started. Target mid-February. By then you've got employer forms in, you've got investment forms in. You should have all your stuff from the previous year. So get started early. Terrific.
We have a link with to Kyle's firm on fox4news.com. Thanks very much.
Appreciate it.
Good advice. We appreciate it too. A brisk Wednesday morning, but just you wait until tomorrow afternoon.